All right, welcome back to the show. I'm your host, Lance Roberts. The Lance Roberts Show podcast right here at realinvestmentadvice.com, where every now and then something goes off the rails. Michael Lebowitz, CFA, online with me today. Mike, how are you, sir?
I'm doing well, Lance. Thank you.
So what was your takeaway of today's market action? It certainly looked like algorithms in play today, really just more than anything else. I mean, fundamentally, nothing has changed. Economically, nothing has changed. Looks like just really an oversold bounce here today.
Yeah, it was very technical. It was bouncing off the lines it was supposed to bounce off of. But this market is very volatile, and if you take your eyes off it for even a half hour, 45 minutes, it can be drastically different than from before. So, I think this market is providing opportunities for those that are uncomfortable to get out. Mm-hmm. But it's also, like you said, potentially providing nice trading opportunities. And by trading, we're talking in terms of days and weeks, not months and years.
Right.
But, if the market volatility is making your stomach churn and keeping you up at night, you need to take advantage of some of these rallies. I mean, today we only rallied 6 or 7 S&P points, but really think about if we do get a Santa Claus rally, where might it take us? And instead of, becoming bullish on a Santa Claus rally, think about what it felt like over the last few days.
Yeah, no, and this is what the interesting thing today is that, I'm writing our Technically Speaking post for tomorrow, and I was writing it this morning before the market opened, and right as the market was opening, I clipped a chart of the head and shoulders pattern we've been forming lately. I've been talking about in the newsletter and at our website at rapro.net. And I clipped it, and we were just sitting above that line. We were about 4 points above it. And, of course, shortly after I posted that chart, the market broke down. We retested the February lows. But had you just looked at the market at the open this morning and looked at where the market closed today, you'd have no idea the market had this 50-point sell-off intraday. And that's the type of volatility that we've been talking about here lately. It's amazing. You have these breathtaking sell-offs and these breathtaking recoveries all in the same day. The bad news about that, though, is that when you do that, we have these oversold conditions that occur, and you're looking for decent trading and buying opportunities. And days like today, where you have these big sell-offs, that rally back already starts eating away at that potential good trade setup, which limits your upside from here.
Right. Right. Opportunities like today, we were down about 50 S&P points.
Mm-hmm. Yeah.
But by the time you really got your hands around, are we going to rally? You made up your mind and then executed the trade. You may have already given up, 30 of those points of what's, maybe a total of 100 points.
Right.
So, it's really a tough environment. And if you're a trader, trade. I mean, there's lots of opportunity. It's a great place to make money. But if you're an investor, look at this volatility very differently and think about where you want to be.
Well, I think that's a good point here, too, is that, if, again, you look at the action today in the markets, and this wasn't, a broad-based recovery day. It was very focused, primarily in tech stocks, right? The market tends to gyrate or to always go back to what is most comfortable and easily traded in these big major tech stocks like Facebook and Microsoft and Amazon and Google and Adobe, and these are the ones that have been the leaders, kind of the big leading stocks at the beginning of this year. And it's kind of that reflexive action by hedge funds and portfolio managers to go back to what they know and what they made, kind of that recency bias. What made us money before? Let's buy that again. Even Apple today, on not such great news, managed to rally because it's been beaten up, but it's easy in. These positions are highly liquid. They're easy to get in, easy to get out of for traders. And again, for traders, it's an easy trade opportunity. For investors, this can set you up for a really nasty whipsaw.
Right, and a lot of those traders use stop outs of many different sorts. So they buy Apple today and they put a 1% stop on it. And a lot of them are using similar stop losses. So that's one of the reasons we get such volatility is they buy the Apple, it starts heading lower, and then all of a sudden all their stop losses from all these different traders starts hitting at once. and it just pushes the market further and further. And that works on the other side too. A lot of people are short the market, and market starts rallying, and they have to cover their shorts.
Right, and that's why. And again, to your point, though, that's why we have these days where we're down. You know, having a 500-point down day used to be a rarity, and over the last few months, we've had regular days where we're down 500 points, 400 points, and now we're getting to the point where, it's just down 400 points today. That wasn't that bad because it was down 800 the other day. And so we're getting used to this, these bigger volatile swings in price. And, an 800-point down day back in 1987 was a 20% decline, right? So, you take a look at where we've come to now. But, these big point moves, those are the earmarks of these high-frequency trading algorithm firms that are, all hitting the same stop losses, all hitting the same triggers at the same time. And, again, this goes back to our conversation we've had before about the risk to these ETFs that even when the algorithms trigger and start selling ETFs, that's entire baskets of stocks that are getting bought or sold at one time.
Right. Lance, on a separate but similar note, one of the things I've been looking at is the Russell. Mm-hmm. And maybe tomorrow you can show the Russell on the graph and kind of what it's been doing.
Right.
And the Russell intrigues me because it's it's smaller companies, so they're not as affected by the trade war with China. Some of those companies certainly are, but a lot of them tend to be more domestically oriented,
right,
regarding their earnings.
Which means they're more impacted by the economy, the domestic economy, than they are trade. Yes.
Exactly. That's where I was going. And the Russell graph looks worse than the S&P. Mm-hmm. So maybe you can share that tomorrow, because the Russell was what led us to these bullish highs, along with the tech stocks, the FANG stocks, etc. So the Russell, just like it led us up, may be leading us down. And if that's the case, the graph is a little sloppier than what we're seeing from the S&P.
Right. It's funny you should say that, because, yes, in the Technically Speaking post for tomorrow, not only do I go to the S&P 500, but we also look at IWM, which is the Russell 2000, but also the S&P 1500, which is the S&P 500 large cap, the S&P 400 mid cap, and the S&P 600 small cap. We look at all those because all of those are suggesting across market caps, across markets, that there is a definite change to the overall tenor and tone of the market. Now, that's just where we are short term. And again, as I was talking about earlier, is that, and based on your article, in which there's a clip from your article in that newsletter tomorrow as well, that very likely we're going to see a trading opportunity here as portfolio managers, hedge funds, et cetera, get repositioned, because mutual funds have to maintain 95% allocation in a lot of cases. So they've been doing distributions, they're underweight equities, and so we're likely going to see some equity buying over the next couple of weeks as they rebalance portfolios for the end of the year. Plus, they need to show that they own all the right stocks, right?
Exactly. It's called year-end window dressing, and that's exactly what it is. And frequently, you also get this at quarter ends as well, but frequently what happens in the last couple of weeks of a quarter gets reversed in the first few weeks of the next quarter.
Well, don't rain on the parade. We're not even in January yet. So, all right, we'll take a quick break. We're going to come back with more with Michael Lebowitz. Mike, I want to talk a little bit about Jerome Powell. He'll be talking on the 18th. What do you kind of expect he's going to do here, and what does it potentially mean for the markets? More with Michael Lebowitz, CFA, when we come back after the break. Don't go away.
Follow Lance Roberts on Facebook or go to lancerobertshow.com.